Bruce, great to have you back. The quarter looked good. The earnings call sounded good, especially in contrast to what we got from some of the bigger players earlier in the week and last week. Why the discrepancy?
Well, I think we put up some really good numbers for the quarter. The balance sheet is well positioned to benefit from rising rates, and so we're starting to see that come through. We saw a nice uptick in commercial loan demand. That was another positive. And while the environment put a crimp in first quarter capital markets fees, the pipelines are still really, really good. And so we think that'll come back as markets stabilize over the balance of the year. When we look out over the remainder of the year, we basically called that revenues would be about $200 million net higher than what we thought in January, $300 on the net interest income side, given the higher rates, but then a little offset on fees from mortgages and capital markets down about 100, net plus 200, expenses about the same, and then credit costs well behaved and should be really good on the credit front for the balance of the year.
Just wanted to pick up on what you just said about mortgage banking, because I know the fee drop was attributed to capital markets, but also mortgage banking, which was a weak spot for a lot of the banks. What do you expect for that business and for the housing market down the road with the Fed getting more aggressive, raising rates?
Yeah, I think the refinance side for originations will clearly be off for the balance of the year with rates being higher. I still think the purchase market should be reasonably strong. There's good underlying supply-demand dynamics that I think you'll see people wanting to move house and get resituated over the summer move season. So we would expect the purchase market to be reasonably okay. Part of the question is there's now excess capacity, which was built up in the industry to handle the refi wave. And so we need to see some of that capacity come out so that margins expand. So we'll see how it plays out. But again, I think there's limited downside from here. We've already had mortgage come way off the highs that it had back in 2020. Again, I think capital markets will help pick up the slack over the balance of the year.
I think the big overarching question for bank investors, small and large right now, is that we finally got the higher rates that they were hoping for. And clearly that's helping your bottom line, and you're very rate sensitive. So that's all good, except with the Fed going so fast now and so big on rates, there are worries about a recession or a sharper economic slowdown. And ultimately that hurts your business. Where do you stand on the outlook and what that'll do for the banks?
Yeah, so, the Fed has a difficult job here. They got behind the curve on inflation, and now they realize the seriousness of the situation and need to catch up. And so it wouldn't surprise me at all if rates go up 50 basis points in the next two meetings, and then we'll see where it goes from there. They still are trying to engineer a soft landing while corralling inflation and keeping expectations, bringing them back into line with a 2 to 3% level, which is, as I said, going to be challenging. The markets still think that they'll have a good shot at delivering the soft landing, but I think a bit of worry has crept in as to maybe sometime in 23 that we could have a brief and shallow recession. We've emphasized today that we really like the way our credit risk profile lays out, both on the consumer side and the commercial side. A lot of the companies that made it through COVID got leaner on their expenses. They went digital. They've strengthened their business model. So the ones that had weaker business models already took a hit on those back in the COVID era. So the book looks pretty clean, whatever transpires, whether there's a light recession or not. And on the consumer side, the consumer's in great shape. Lots of liquidity. They bankrolled a lot of cash during the pandemic, starting to get out and spend again, but don't see any signs of distress at all on the consumer side at this point.